Morning, everybody. Welcome to today's meeting of the Local Pension Committee. As usual, this meeting is being broadcast live to the public. Those not able to watch live, the webcast will be recorded and made available for viewing on the County Council's website after the meeting. Before we begin, can I please remind everyone to only turn on their microphones when you wish to or are invited to speak. I've received apologies from Councillor Lee Brecken and Councillor Asaya Bora. As this is the first meeting of the council term, it will be useful for members and officers to introduce themselves, please. On my left.
Adam Clemens, Solicitor, Team Leader, Head of the Litigation and Prosecution Team, deputising for Assistant Head of Law, Patrick Tuff.
James Henry, Executive Director of Finance at Loughborough University and University Representative.
Councillor Martin Cartwright, this district's representation, elected to Incling Bosworth Borough Council. John Bloxham, representative from Leicestershire County Council.
Hello, Rupert Sims, employee representative, and Ms Smith, I hope you don't mind me pointing out just for future references, Asia Bora. Yeah, thanks.
Councillor Jeff Whittle from Leicester City Council.
Whittle Betcher, Member Rep.
Sheila Stephanie, representative from LGPS Central.
Mark Davies, also from LGPS Central.
Louis Hill, Client Director from LGPS Central.
Hi, Bolesh Katra, Strategic Finance Manager, County Council.
Morning, Kat Tui, Responsible Investment Analyst at the County Council.
Simone Hines, Assistant Director of Finance at the County Council.
Declan Keegan, Director of Corporate Resources at Leicestershire County Council.
Daniel Greenley, Representative of Leicestershire County Council.
Councillor King, Representative Leicestershire County Council.
Nick Booth, Member Rep.
Thank you. The first item on the agenda is the appointment of chairman. I'd now like to ask for nominations and seconders, please.
Can I propose Phil King?
I have a seconder. Are there any more? Mr. Whittle. Are there any other nominations? Can I have a show of hands then, please? Mr. King, want to take the chair?
Okay, can you hear me okay? Thanks, Angie, for that. Thank you, everyone, for your continuing confidence in me to chair the committee. Really is a privilege and an honour. So moving on to agenda item 2, which is the appointment of vice chair. We're going to ask for nominations and seconders for the position of vice chair. And so I'm happy to propose Mr. Grimley. Can I have a seconder for that, please? Mr. Whittle, thank you. Is there any other nominations? No, okay. So can I just...
Sorry, yeah, carry on.
Sorry?
That's it then. I'll read out the vote then.
It just says, can I ask for a show? Oh, no, only if it's more than one nomination. Okay, all right. Over to you, Angie.
Can I have a show of hands for that then, please? Thank you. Mr. Grimley, do you want to take the chair, please?
Okay, so thanks for that, everyone. And so first of all, I want to just take a moment to express our thanks to Councillor Roy Deeney's time on the Pension Committee. He joined in June 23, and but I understand he's now been replaced by Mr. Brecken, who used to be the lead member for finance here at County Hall, so he knows a great deal about financial matters. Unfortunately, personal situations happened first thing this morning, so he's not able to make the meeting. So he sent his apologies, but I'm sure he'll be here at the next meeting. But obviously, Roy, had quite a lot of insight into investment matters and market conditions. So we're going to move on to item 3, which is minutes of the meeting held on the 20th of March 2026. I'd like to move the minutes held are taken as read, confirmed and signed. Is that agreed?
Agreed.
That's agreed. Thanks very much. I've just got to sign those in a moment. And just I move on to item 4. Can confirm there are no questions have been received. Item 5, questions asked by members under Standing Order 32.1. No questions have been received. Item 6, any other items which chairman's decided to take as urgent. I can confirm there are no urgent items to be taken. And item 7, can I ask if any members have any declarations of interest in respect of items on the agenda? Anybody? No? Okay. So the first report on today's agenda is the LGPS Central Presentation Report, pages 19 to 50 of the agenda. Bullish is going to introduce the report, and we have Louis Paul Hill again, and Mark Davis, and Sheila Stefani, and Bullish. Do you want to go ahead? Thank you very much.
Thank you, Chair. So this is our usual quarterly presentation from Central, and this time focusing on public markets. In addition, we've got an overview on how Central will develop investment solutions. That too will be presented. We've got a bit of background on Central between points 4 to 13. The fund now invests via 14 products, a total of 4.6 billion as at the 31st of March date. That covers both public and private markets. Across public markets, which we're interested in today, we've got 4 products: a global active equity product, a climate multi-factor fund, a passive equity product, multi-asset credit, investment grade credit, and those total about 2.5 billion as at the 31st of March date. Moving on to Central in general, the fund is a stakeholder in Central from 2 perspectives. So we're a co-owner of the company, a shareholder if you like, and also a recipient of investment services. So we're both client and shareholder. From the 1st of April 2026, all investment mandates will come within the pool's oversight remit. We've heard about this over previous papers. That date is now passed as they transition towards a larger asset management business. Since early 2025, officers and Central have been working closely to progress the outcomes of the Fit for the Future consultation. We've got a couple of points at point 14 showing the main areas that have been worked on. To enact those proposals, government have introduced the UK Pensions Bill, which received royal assent on the 29th of April and becoming the Pension Schemes Act 2026. Of the 8 original pools across England and Wales, government supported or expressed preference for 6, including Central, 2 pools which represented 21 LGPS funds, who government invited to engage with the remaining pools, determined which pools they wanted to form a partnership with. The original 8 partners on the 1st of April admitted 6 new partners. Together, these 14 funds collectively formed one of the larger LGPS pools. Those 6 new additions are Norfolk, Suffolk, Oxfordshire, Hampshire, Wiltshire and Gloucestershire. Any other questions at this point before we hand over to our colleagues from Central?
Mr. Cartwright.
Thank you, Chairman, and congratulations on your re-election. Just on the 8 pools, it'd be helpful, not now, you won't be able to give the information now, but it'd be helpful in the minutes just to distribute what all the 8 pools are, whose members. I know we're a member of them, but of who the members are. You talk about the 6 into the 8 to see what the new structure looks like. Now it's all been basically sorted out.
Good morning. So we've got 2 LGPS Central presentations today. The first one Mark and I will cover, which is covering public market performance, alongside a bit of a fit for future update in terms of our asset class solutions and our investment decision making on your behalf. And then Sheila will follow later, covering stewardship. Certainly from Mark and my perspective, happy to take questions as we go.
Okay, thanks for that, Louis. So Martin, what I'm wondering is it you want a sort of just a very like a briefing note sort of type of thing? I'm wondering if we can get a briefing note for members. Also, I think that would be actually quite useful for wider members of the Leicestershire scheme, just to explain, you know, what the changes are and, you know, who's now part of our group, etc., etc. If that's something we could do, and we'll probably base it on what your presentation is, but I mean, just if we can pull that together, I think that'd be quite helpful for everyone. And then that just all the partners locally to understand, as well as members of the committee, and also I suspect the board. Yeah, because I think it just helps clarify, because it has been, shall we say, a bit of a long road.
We can pull something together and we'll pop it on the website as well for that wider sort of interest. Yeah, I think that'd be quite a good idea to do that. Everyone, so okay, so we can move on. Any more questions for Bullish at the moment? No, okay, do you want to crack on with your presentation then? Thank you.
So we're going to start with a market update, which kind of sets the backdrop, and then Mark will talk about equity performance, and I'll cover your bond performance with LGPS Central. I don't know if you guys can see the detail on here. What we're showing here is performance of the main equity, bond, and alternative markets up to end March for the public markets, and for the private markets to end December. I think the key things that I would draw out from here is that it's been a pretty tough first quarter of this year for all markets, equity and bond markets. This is as you'd expect from what was going on with Iran. The concerns about the impact that would have on inflation, and therefore the need for interest rates to remain higher for longer. So that has an impact both on bond markets and equity markets, hence Q1. We are long-term investors, so that is only your background interest. We try to focus more on the longer term numbers here. So we've got up to 20 years on here, as well as 10 and 5 years. And actually over the medium term and the long term, equity markets have been extremely strong, I would say. And the reason I can judge that that's extremely strong is that, you know, I advise LGPS on strategy and have done for many years. And to do that, we think about what we expect from different markets. And typically what we've been expecting from markets is a kind of 7, maybe 8% per annum type return from equities. And so we have seen, particularly from US, which is the predominant global market which you are invested in, way above that. The UK equity market has actually over the long term delivered around what we expect, but the US and the global market has delivered considerably above that. So we've enjoyed strong returns.
Yeah, Mr. Bloxham.
Thank you, Chair. Just a quickie, just on the returns, it would be useful for us for the future if we just had a benchmark for each of those categories, so that we could see, you know, how they're doing in comparison to what we'd expect.
We certainly cover that in another paper on the valuations paper, but there's also a summary paper within the private agenda which shows performance by mandate as well. But we can direct you there as well.
Can I just answer? So what we're showing there are benchmark indices. That is not the fund's performance. Those are benchmark indices. The source for them is back on page 24. So, for example, global is the FTSE All World Index. So these are all.
Yeah, completely misunderstood that. Apologies.
Yeah, this is not. We'll come on to fund performance. This is just the market backdrop. So equity performance has been extremely strong. Fixed income, if you kind of look at that section, a lot more kind of red on there. So far lower returns from fixed income, which we would expect. But we have seen actually some negative returns in recent years from fixed income assets. This is a result of inflation increasing, short-term and therefore long-term interest rates have increased and increased quite dramatically, and that's led to prices to fall. Hence, in the medium term, we've seen some negative returns from fixed income assets. Longer term, lower returns, certainly than equities, which is what we would expect.
Okay, Martin, did you have a, sorry?
Yes, thank you. Obviously, this changes on a almost daily basis, so inevitably data is always going to be out of date. Specifically, when you talk about the American markets, the question is around technology, which we've done particularly well in over a long period of time, especially investing in new startups that have gone on to be super companies. But the opposite end of that is like SpaceX, which was extraordinarily overvalued and crashed immediately the following day. So none of that can feed into this yet, of course, but particularly the technology markets in America at the moment are quite fragile because of the boom bust scenario has happened over many years. So I'm just wondering how that's likely to feed into the future, given it is very recent.
Okay, Louis, do you want to try and answer?
I will start, and I'm worried that I'm stealing Mark's thunder here. So a lot of the reason for the global markets being strong, and particularly the US being strong in recent years, which we've spoken about several times, is that
we have done
AI boom, if you like, those big tech companies, Nvidia and Microsoft and so on, that have seen their share price, have seen their earnings increase massively, but have seen their share price increase even more so. And this is what you're kind of referring to. So your passive investments, which you have a relatively large amount in, will have just followed, and you'll have large allocations to those companies as a result of that. And your performance has been very good as a result of that. But what Mark will talk about, our actively managed fund, the active managers have chosen to underweight those type of companies.
Yeah, I think again, Louis, we've talked about this before at a previous meeting, at least more than once.
Yes.
So I'm quite happy for you to move on, so if we can, because
we'll come to it in more detail
on the agenda, unfortunately. So we need to get moving.
Understand.
Sorry.
I will very quickly cover this. So you can see on the top two charts, which is the Bank of England rate and some of the other central banks' rates over the last few years, and the UK government bond yields. You can see the big jump in interest rates, both in short-term and long-term interest rates. The point you're referring to is reflected somewhat in the bottom left long-term price earnings chart, where we're showing effectively the relative expensiveness of US stocks relative to other stocks. Always wary that, and something you could say that looks expensive, we shouldn't be investing it. It's looked expensive for a while and it's performed very well. So market timing is very, very difficult. And the last chart is credit spreads, showing how much extra reward you are getting for investing in companies' debt rather than government's debt. And at the moment, it's not much additional return you're going to get from that investing in corporates rather than governments. Should we move on to performance of your funds?
Please, let's.
Good morning, everyone. I'm going to talk through the next slide, which is the performance or table of all of the assets that you have in public markets with Central. The top four are within Central's actual own product range. So that's a global active equity fund, and you'll see on the 3-year number that fund performance is behind its benchmark. I'll come on to that and reasons why later. The next one is a passive solution. So again, you can see that it's basically performing as or in line with its benchmark. And then the last two are active fixed income strategies. And again, looking at that 3-year line, you'll see that they are both ahead of their benchmark. So 3 out of the 4 funds that LGPS Central runs for you are beating the benchmark. So very good work there. The bottom 3 funds are allocations that you have via an external provider called Legal and General Asset Manager, but Central undertakes the oversight of them on your behalf. As I said, I'll dig a bit further into the global active multi-manager funds to explain what's been going on there over the last 12 to 18 months. So on the next slide, you'll see the market backdrop. The last 10 years has been a very struggle for active managers as we've seen markets concentration, those Mag 7 stocks increase. This doesn't give fertile ground for stock pickers. They tend, as we made comments, tend to get worried about US tech positioning, so they've shied away from those holdings. This isn't the first time where we've seen this headwind to active managers. It happened in the 70s in a period called the Nifty 50. You've seen it again when there was a period called the Four Horsemen. We saw it again with FANGs, and we've seen it with the Mag 7. What tends to happen is, and the tech boom obviously in the early 2000s, what tends to happen after these events, or the market calls these periods of concentration, they give them nicknames, you tend to either see the bubble pop and markets draw down, or you see the market starts to broaden. So some of those positions, those active managers are holding, start to outperform, as well as people get concerned around those highly concentrated positions. So we're in a position now where active managers are on board for 10 years, and we've got to assess whether that's going to continue, or whether we think history will repeat itself to a certain degree, and then we'll see a broadening. And just anecdotally, and it is the green shoots, we have started to see that over the last 2 to 3 months. So since this quarter period ending, you're starting to see a bit more broadening. The Mag 7 have actually marginally underperformed, and you're seeing more AI infrastructure type plays start to generate some significant returns. So the active fund, we think, is well positioned for the next 10 years. It's struggled over the last 18 months, as I stated. You can see a bit more detail on the performance on the next slide. As way of background, we use those 4 managers that you can see listed there: Harris, Schroders, Union and Longview. They all have very different styles, so we blend those managers together to ensure that we kind of can offer smoother return profile over the longer term. Harris is a value manager, so these look for really cheap stocks that they believe are undervalued. Therefore, you would expect them to be underperforming when a kind of like the US tech is running hard. They're very expensive stocks. Harris naturally wouldn't be buying those, and therefore they lag the index. Schroders is more of a growth at a reasonable price, so you can see that they've performed relatively well and keeping in line with the benchmark over the last 3 years. And Union is a bit more of a momentum player, and they've lagged with that style of investing. A relatively new addition in the last 2 years has been Longview. These are a quality manager. These managers will outperform, when the market does have a drawdown. They invest in defensive companies, kind of like strong consumer names with strong balance sheets. And in the current market environment, they have struggled significantly, as you can see there, their level of performance. The fund in general, over every calendar year since inception, has been in the second quartile until 2025. That gives you some indication that the fund, whilst it's underperforming its benchmark, is actually beating its peers. Every year it's been above average, and so something we're quite proud of. And that long-term track record over 5 years still remains, but the last 12 to 18 months have been a struggle. I'll happily take any questions on the Global Active Fund at the moment.
Okay, anyone got any questions for Mark at all? Dan?
It's just a very quick comment. It does look like there's a good sort of spread of different investments there, which is good. So that's quite pleasing. We're not putting all our eggs into one basket. Thank you.
Yeah, did you want to answer that, Mark?
No, that's right. That's the benefits of a multi-manager fund as well, as it brings that diversification. It brings different styles of investing to the fore, to blend them together, rather than kind of bring it. If we'd just gone with one manager with one style of investing, you could see even more volatility in performance. So it's something we try to achieve.
Okay, Dr. Bloxham?
Yeah, just a quick one. Are these returns before charges or after charges? And are the charges quite steep with it being multi-manager?
So these are all after fees, net of fees. For public markets, the fees aren't as significant as they can be in private markets. So you're looking at a kind of like a management for each manager charges a different level, but on aggregate, the fees are around the 20 basis points. So 0.2%.
Okay, all right. Okay, do you want to move on then? Sorry.
Yep. And so the next fund is a passive approach to investing. It's the All World Climate Multi-Factor Fund. So this is a fund that targets long-term drivers of excess returns. So those are value approach to investing, quality, low volatility, and small cap. And then it has a climate overlay. Here you can see how this approach has performed relative to a market cap weighted index. So again, within that bottom line, you see under 3 years, the FTSE All World has returned 14%. So that is the kind of like the standard benchmark, what's on that first page for representing global equities. But you'll see that this style of investing, this multi-factor approach, has delivered 15.88. So whilst it's a passive solution, it's tilted towards those factors that generate those excess returns over market cap. And you can see that in the numbers there, that it's generated over 1.5% in excess returns, even though it's a passively run approach to the benchmark that's calculated by FTSE. It is Central's current largest fund. It's about £6 billion sterling. Happily take any questions on that passive approach.
Anyone got any questions at all? No? If you'd like to move on, that's great. Thank you.
No problem. I'll pass on to Louis, who's going to take you through the fixed income.
So starting with the investment grade corporate bond fund. So this is lending to those large high quality companies. I touched about the spread above government bonds being fairly low at the moment. This fund's benchmark is 50% in sterling issued bonds and 50% overseas issued bonds. We have two active managers aiming to outperform the benchmark by 0.8% per annum over the long term. As Mark said, the managers are doing a pretty decent job here, outperforming relatively strongly over 3 years, not quite achieving target since inception, outperforming by 0.5 after all costs. And both managers are pulling their weight, albeit like in equities, we've chosen managers that perform well at different times, and these managers have done that.
Okay, anyone got any questions on this at all? No? Okay.
Okay, the next one is Global Active Multi-Asset Credit. So multi-asset credit can effectively invest in riskier areas of credit, so lending to companies and others, but also can move the allocation around, can choose which areas of the market to invest in, so has a dynamic element to it. Again, this is made up currently of two managers, although we are replacing, in the process of replacing one of those managers with two other managers at the moment, following a thorough due diligence process. In terms of the performance, the benchmark here is not a market benchmark, it is a cash benchmark. And cash has been particularly difficult to beat over this period as cash rates have gone up, but because of that increase in interest rates, bond prices have fallen. So that cash plus 4% target has been extremely difficult for any manager investing in bonds to achieve. We are moving to a market benchmark going forward. As I've said, we're replacing Western with two other managers, which will come through next quarter.
Okay, anyone, sorry, Nick, sorry, just do we go back to that? Nick, you got a question? Yeah.
Why were you? Why was the manager being replaced?
Western.
Yeah, why?
So they are being, so there's a few issues going on with them. So historically there were some performance and governance issues and ESG issues. So particularly the big thing was one of their portfolio managers, not directly linked to this fund, but it was a bond manager, there was some SEC and DOJ investigations into their behaviour and their booking of performance, which kind of caused us to question their investment process and their culture generally. It's also caused many other investors to question that, and there has been significant outflows from the manager, which then kind of can impact on staff and the business as a whole. So for that reason, we started looking at other managers and found better managers out there, and so have initiated the switch.
Yeah, I'll come to you in a moment, Martin. So Louis, just Leopold, just dwelling on this a bit. So we're changing managers, but does that mean we're changing our investments at the same time that are being managed by these people, or does the investments stay and it's just the people? Can you just clarify?
Yeah, so there will be some overlap in the underlying bonds, but not full overlap. So the transition will be managed as efficiently as possible. Your holding will be in the LGPS Central Multi-Asset Credit Fund, and we will manage the transition underneath that.
Right, okay, so it's okay, right. Martin, over to you.
So in a risk-based scenario, taking extra risks usually, hopefully, gives it better gains overall. Otherwise, what's the point of taking the risk in the first place? And given the investment strategy across all of the investment managers in the portfolio and the returns we've been able to achieve, which has been fantastic, just trying to understand at what point we would decide that the risk isn't worth the benefit because it's underperforming in relation to the risk that we're taking in the first place. So I'm really trying to understand why you'd stay invested in risky investments that aren't astronomically proving to be beneficial, because the risk then becomes not worth taking, if you understand.
Okay, do you want to try answering that?
So, well, your riskiest assets are probably your equities, which have performed very well over the long term. I think through time, because of the success of equities and other assets, the funding level of your fund has improved, and you have been de-risking through time into private markets and bonds and such like. So there is a very gradual de-risking that has happened. We are long-term investors though, and we can afford some of that volatility because we want those higher returns to help us pay pensions and so on. So it is that balance I think we need to strike.
Okay, Bullish.
Can I just add to that? As part of the annual process when we review the strategy every January, that's exactly the kind of question that is posed to the investment advisor. Are we taking the right amount of risk across all our asset classes for the return that we need? So it is addressed every year.
Yeah, Martin.
But the answer borne out my concern really with de-risking into private markets. At the last meeting, private markets were a concern too. So if you put the two together, that's why I raised the question. That was all.
Do you want to try answering?
I can try. So at the last meeting, we did come off a little bit. I mean, one of the main changes we made last time was to take 2% off this multi-asset credit fund, and effectively we added 2% to UK bonds. So that's a bit of de-risking into public markets in that respect. So we try and take all aspects into account. But as Louis mentioned, we are very long-term investors and we can afford to take a lot of volatility and risk.
So I think that if I was just going to use Chair's prerogative, I think the other thing is, as you're presenting, as I understand these figures, this is capital values return rather than dividend income.
So it's total.
Which is total.
These will be total returns.
Right,
Yes,
okay.
absolutely.
Right, that's very helpful. So I'm thinking this is capital now. Okay, so it's a combination of the two together. Right, okay. Excellent. There we go. Right, do you want to move on to the next thing? That's great, thank you.
So the next section is moving away kind of from past performance and kind of thinking about the new world that Fit for Future has put us in. So Fit for Future regulation and guidance is now out. And one of the kind of key elements of that is that the pool, LGPS Central for you, will be making the underlying asset class decisions. So what remains with the administering authority is the high level, what investment return do we need? And to the member's point, how much risk are we comfortable with and what returns do we need? And then to achieve that, how will we allocate to, the government has set out 9 asset classes. So equities, credit, government bonds, property, private equity, and so on. So that's the key decision that remains with the committee. Underlying that, so what equities to invest in is a pool decision. That's a key part of the regulation. What we have done then is go through a process, which I'll just describe now, about how we will decide what LGPS Central's equity offering will look like, what our credit offering will look like, and so on. So the process we've gone through is described here. And the essential bit of what our process is listening to our clients, who are our clients and our shareholders. And so we want to do something that meets your needs. So all of our clients shared their investment beliefs, their preferences, how their current strategy maps to those 9 government buckets, and also how it maps to underlying components. So that was the first step in the process. We then did an analysis of that. So some of the kind of outputs from that analysis of there was a huge amount of shared investment beliefs. You're all investing to manage your liabilities. You all believe in diversification. There's a belief in the illiquidity premium and risk management and so on. So there's a huge amount of shared beliefs. Major differences in beliefs in responsible investment. And I'll come on to that a little bit about how we're planning to deal with that. The third step is that LGPS Central researched what we thought the best ideas of managing LGPS money in these asset classes. We asked for input from clients. We also hired a consultant for their input at that stage as well. We then presented back in the 4th step what our view of the best ideas to run these asset classes was to clients. We received feedback, and then finally we've made a decision on the underlying components we should have. I've noted at the bottom there's still work to be done. So we haven't decided on all asset classes. And the big area that there is work to be done is in this area of responsible investment, where we are likely to have a core approach where environmental, social and government is part of the investment process, looking for financial opportunities and managing financial risks. We are also looking at a offering for clients that want to have a more targeted approach in responsible investment and achieve certain, for example, social or environmental objectives, a bit like in local, which is another thing that's come out of the regulation, local investing. That's the process. The next page shows where we have got to with some of the main asset classes. There's a lot of detail on here. Effectively, we are going to have 5 or 6 equity components. So some of them you already invest in. So the active global equity, like Mark's talked about, the multi-factor equity, and also passive equity. So we're going to have those components. We'll also have emerging markets and a UK equity as well. Within fixed income, within credit, we're going to have a global corporate bond fund. So that's slightly different to how you're invested at the moment, which is a split between sterling and global. So we will talk to you in due course about moving that to be global. We'll have emerging market funds and the multi-asset credit like you have now. And then we'll have an offering in government bonds, which we think will meet your needs as well by those 3 funds, one conventional and 2 index-linked gilts.
Okay. Has anyone got any questions at this point, Tom? No? Okay.
So the next steps, the key point, I think, is there's no big bang. So at the moment, you have some investments in our funds and some investments out of our funds. We will not transition you out of where you are invested currently into our funds until, firstly, those funds are in the right place. So some of those funds are new funds being created. Some of them are evolutions of existing. So we won't do it until we have something in place, obviously, but we also won't do it until we have consulted with you and explained the rationale for any movement. So that's the key thing. The investment team, so Mark and his team, are working hard to get those new funds set up where they're required or evolve existing funds where they're required. We're beginning this process of communicating any changes. We're also continuing this work on creating new solutions, for example, in that responsible investment space where needed. And then once all that work is done, we will organise an efficient transition.
Okay, any queries about that at all? No? Okay, so we'll move on then to the next
investment decision update. So this is again another fit for future regulatory requirement that LGPS Central takes on the investment decision making for implementation. However, given that the timescale that was forced on us, we are not fully operational in being able to take on all of the elements of investment decision making, and in particularly the what we're calling the total portfolio management is not fully operational. So by total portfolio management, that's the ability to have inputs in terms of valuations and full analysis of how the pension fund is invested, and then make decisions on rebalancing, moving cash around, and so on. So we don't have that set up given the timescales. So what we're doing is we're working very closely with the officers who are continuing to follow pension funds' existing policies and processes. But then when there is an investment decision to make, we need to sell this asset and buy this asset, for example, that's passed to LGPS Central, so we can be compliant with regulation and make that decision. We've developed a 4-stage process for those decisions. The first one is we take that is the intake, where it's just about logging it and being clear what the action is. Then we classify it, and there's different classifications. So there's things like portfolio decisions, which is that all important buy or sell. There's governance decisions, which might be that you have a fund, for example, a private market fund that is looking to extend. So there's no buy or sell decision needed, but there's a paperwork needs change that has an impact on the underlying investment. And then there's operational things like meeting capital calls for private markets. So we classify what the decision is. Then the next step is we decide who is the right person or team or group of people to make that decision at LGPS Central. So we make sure that it goes to the right people. And then there's that oversight role to make sure that the process is followed, the policy we have is followed, and that they coordinate to ensure a decision is made in the right time and then logged correctly. So we've got a process for making all those decisions. An example decision that we have made on your behalf recently is what Bhulesh has referred to, this decision to change the strategy, move 2% from multi-asset credit to government bonds. In practice, that was actually funded from cash. So that was a decision, if you like, a strategy decision agreed with committee prior to 1st of April with Hyman's advising, but the implementation was post 1st of April, so it needed to be an LGPS Central investment decision. We effectively made a decision to use Legal and General All Stocks Gilt Index with a rationale set out on that page.
Okay, can I just ask you, Louis, for future reports then, is this how you're going to be reporting investment decisions in this kind of format? Is this, or are we not going to get that information?
I suspect there will be a different format that we will agree in due course, but we haven't agreed that yet.
Agreed between what LGPS Central are going to agree, or between you and the officers? I mean, who's agreeing between whom, basically?
Yeah, so probably both. So I think what we will need to do is think about, so all clients are going to be wanting reporting on investment decisions, so we'll need to create something that works for all clients.
template. I just think this is, I mean, I don't know what other colleagues think, but I actually think this is quite clear. So if I can put it like that, you know, because there's a lot of detail and sometimes this, you know, that to me, this seems quite clear as to what's happened, why you've done it and what the outcome is, which is good. This is all we want to know, really.
And the aim will be to be clear on that. Absolutely. Yes.
Okay, that's great. Thank you. Has anyone got any queries or questions on this section at all? No, we carry on then. Thank you.
I think that is the
You're at the end. Okay, right. Okay. All right. So if there are no further comments or questions, the recommendation is the committee is asked to note the report and presentation. So is that agreed? That's agreed. Great, thank you. So we're now going to move on to item 9, which is the responsible investment update. This is at pages 52 to 92 of the agenda, and Kat is going to introduce the report. And apologies, Sheila Stefani is on this part of the on this report from LGPS Central, who's going to also deliver a presentation as part of this. So over to you, Kat. Thank you.
Thanks, Chair. This is the normal quarterly report of the fund's responsible investment activities, including progress against the 2026 responsible investment plan, recent voting and stewardship activity, and then LGPS Central's presentation on their approach to stewardship. As always, responsible investment remains a core part of the fund's fiduciary duty. It focuses on the integration of financially material, environmental, social and governance factors into investment decision making, which is distinct from ethical investments, as it is driven by financially material and long-term investment outcomes. The committee received a report at the strategic asset allocation review in January 2026, and that included some recommendations from Hyman's strengthening responsible investment activity beyond climate risk, maintaining an engagement first approach, and understanding the escalation expectations from LGPS Central, which are appended to Central slides. So committee agreed the responsible investment plan in March 2026, and progress against that is set out in Appendix A. While discussions and development of items such as the review of the net zero climate strategy have been progressing, we had been intending to bring it to this meeting. However, given we still awaited our guidance and with Central's development of their approach to responsible investment, we thought it best to delay to make sure we have appropriate alignment with regulation and with LGPS Central and partner funds. As I think it was referenced earlier, we have now had the government guidance that came out early this week after papers were published. The guidance is still clear that we need to ensure environmental, social and governance factors are considered where financially material, and that we need to work collaboratively between funds and LGPS Central. So there's no change for that on our behalf. Before I hand over to Sheila, I just want to highlight paragraphs 23 and 24 of the reports. So this sets out that the Scheme Advisory Board recently received correspondence from the local government minister. This was in response to a letter that the Palestine Solidarity Campaign sent last year, that we and most other funds received. So the minister reiterated the government's position that decisions relating to sanctions, boycotts and divestments are matters of UK foreign policy, and therefore for central government rather than local authorities. The letter states that local authority pension funds should not adopt investment policies that go beyond or will differ from UK government sanctions or foreign policy positions. And government have also set out in the guidance that just got released that funds should not specify individual holdings, investment managers or geographic zones of investment other than in regard to local investment. So that's the position we have with that. If there's any questions, otherwise I'll hand over to Sheila.
So before you move on then, so has anyone got any questions for Kat at all? No? Okay, so we can move on then to Sheila. Thank you.
Good morning, everyone. And there will be a little bit of duplication on what Kat said. I'm going to start just with an introduction on what is stewardship. We are using now the new definition of stewardship, which is actually being released by the Financial Reporting Council. That is the responsible allocation and management and oversight of capital to create long-term value for client and beneficiary. So what it means for public market, where we all, as an investor, we all have the opportunity to vote at AGM, and also we engage for making sure we can protect and enhance long-term value of the company. Here, when we're talking about stewardship, we're actually talking about basic corporate, also go back to basic corporate governance to actually make sure we work with the management of the company to secure the long-term success of the company. This is the foremost, most important aim that we have when we steward our asset. But how we do it? We want to be collaborative with the company. We try to create constructive dialogue. This is the thing that I've actually worked very hard when I joined responsible LGPS Central back in 2023. Now we have direct access to the board of the company we want to engage. So, because also we have to be effective, we need to be able to come back to you and tell you what we have achieved, why we have engaged with the company. And this is something that now we produce for all the pension committee and is online. We provide every 6 months a report, which is telling you which company we engage, what we achieve, how confident we are to achieve the KPI that we set, and the next step. And I will show you later in the slide one of the example of this. And next slide is, you might have seen it already. This, and apology for if you've seen it already. This our current approach, which is we work with the partner fund. This is a collaborative effort. We're not doing on our own. We are very actually thankful to the partner fund to provide feedback. We develop every three year stewardship strategy, and which is actually coming to an end this year. And back in 2024, we decided that we want to concentrate on 4 themes, which were climate, natural capital, human rights, and what we call sensitive and topical issue, which is really means controversy. Company that we believe, which actually just received a controversy, we need being able to engage with them. Like ArcelorMittal, I don't know whether you have heard, they in their Kazakhstani site, there were 40 people died. Was a fatality of 40 people. So in that instance, we engage directly with the company. But what does it really mean? Because it needs to be, whatever we do our stewardship approach, we need to be we have to have a very robust structural approach. First, every engagement actually get allocated 1 or 2 objectives. We are very clear of the objective we allocate, and we will report back on how we actually achieve that KPI. And in the future, we want to also extend our reporting on how we actually decided the actual KPI. And second thing, we have an effectiveness matrix which is also called measure of success, which is also available in the appendix. And one thing we also do is good governance. Good governance is a bedrock of what we do. So we have every year we review the voting guidelines, which are public available, and also they help us to provide the guidance for the voting decision that we later disclose to all partner fund on a quarterly basis, and also they're available on our website. And finally, as said, we are one of the few I think we are one of the few pool and investor which produce such a level of transparency on the outcome base, which you can always find it in the annual stewardship report and in the 2 quarterly stewardship report. But we cannot do everything on our own. We're talking about I think we have over 2,000 issuer in our public market. So we also rely on Federated Hermes, which is our stewardship oversight provider. So we do in-house, we do a bucket of around 100 companies that we engage and we vote. And we have we also work with Federated Hermes that they will actually steward the other asset that might be not might have less exposure. What we do, I want to be very clear, the way we decide also the engagement, we will actually engage with those companies which we believe they are material issue on ESG in terms of ESG, but also are overweighted in our portfolio because they are the stock. We are gonna be convicted for a long time. In the next slide, as I mentioned before, we are now at the end of the stewardship strategy 2024-2026. So we are actually now working for a new strategy, and we have reached out to all partner fund for the first round of feedback of what is working, what they would like to see in the future, and we will bring it back to the partner fund as well as the LGPS Central Governance Committee review version in the first one in August, and we'd like to have it live by the 1st of January. And what we are trying to do, which is different, we are very thankful that we actually receive quite strong support of the current strategy, the current reporting, but we want to be a little bit more ambitious. We want to be able to be transparent on all the engagement that our manager do, because there is not still this is not our problem, it's an industry problem. It's very difficult to collect all the manager engagement and to be able to have one place where we can report back to you. And this is one of our technical achievements. We want to be able to do this. And the second thing, we want to reorganize a little bit the stewardship priority, because I think we believe climate and natural capital will be better called like physical resilience, and human rights and controversy, social resilience. And one thing we're not very good at actually disclosing. We always do engagement and voting on corporate governance and investor rights. We just took it for granted. We can't do engagement, we cannot do stewardship if we don't have good governance. So we will be better. We will actually display better in our strategy. This is the bedrock on how we steward the asset. And we want to actually continue the dialogue on escalation, because we can, and escalation is not just that we engage with a company, we're not satisfied with the outcome of our engagement, and we keep moving forward. We get more robust engagement. You can actually see our escalation framework in the appendix. It's also the other way around. Sometimes we were able to de-escalate our engagement because we succeeded. But we want to have a further conversation, because there is different escalation strategy for active managed and passive. This is something we're currently working with the passive team. And lastly, we do some advocacy approach. We do some advocacy engagement with other investors. We want to create, we are working to create a matrix that you will be able to see how effective we have been. There's the same thought that we have in for the other corporate engagement. We want to be able for you to trace what we are doing, what we're achieving, why we're doing it. And that is actually the changes we're making. The next slide is about voting. we do vote a lot. As I said, corporate governance is the bedrock what we do. We annually vote nearly 50,000 resolutions on over 40,000 meetings. And we want to work with the management of the company. So you will see that the dissent level of our voting is not very high. We're talking about just 14%. Dissent means that we will vote against the management recommendation. And if you had a chance to look at the table to the right, you will see the area where we tend to dissent the most is the board structure and the board composition. The reason is because this is the majority of resolution we have to vote. It's a sheer size of resolution on this. And pay remain one of the most contentious issue. We're not one of the areas we're actually very keen on pay is not itself quantum, it's the way executive can get paid. They need to be linked to our financial performance, financial return. We don't want pay like in the US. There's still the situation where there are executive plan with no performance target or no disclosure. What has been the achievement of the executive pay? What has been the target which justify such award? That we need that disclosure. And the next one. The next slide is just, I just want to show you one of the first page of our outcome report. This is about what our priority engagement company, what we achieved. Level 3 means that we have achieved our objective. So it means that we're no longer engaging with the company, or we're still talking with the company, but it's still an update. And we have allocated to all the company an objective. We engage with, as again, we have a commitment to engage with all the company that is in our priority list. But if we want to go back to more the basic, why do we actually engage? We have some, as all portfolios, they have systemic risk that can be, which actually can distract, they can actually distract the business continuity of the company and their long-term success. So it could be climate, could be human rights, could be workforce, and good corporate governance. So we only are focusing on real outcome, making sure the risk and return are protected, making sure the company are actually working are mindful the regulation can come is sometimes best practice is not adopted. And we also are universal owner. And so here I also bring you two examples, one about human rights, that has that could be loss of business continuity if we have some human rights abuses or some lack of good governance of human rights. As you have seen, Boho, all the supply chain example. And also good governance is still one of the main lead of revenue loss for investor and return loss. So a company like Carelion, company like Henron, we have seen as actually how can actually affect the long-term shareholder value. And here I've got two examples. OCP, which is a phosphate producer in a contested territory. Contested means is in a conflict zone, which is between the border. It is in the Western Sahara, which is a contested area, which is in current dispute with the Moroccan government. The company is owned by the Moroccan government. We've been engaging with the company about the human rights process, especially access to remedy and grievance, because OCP, one of the main markets where they operate is the European Union, and the European Union now is actually adopting a regulation on track by chain, which actually require a full disclosure of the human right supply chain. So we have asked better disclosure all the different process in order not to lose their contract in the EU. And Thermo Fisher Just Pay, we've asked for better disclosure, and also we want to be able to pay executive for more than one objective. So just one objective for their long-term plan is unacceptable. We are talking about millions and millions, and it can't be that they only have to meet one objective and they not even they not tell us what is the threshold, what is the target. We need to know why are we paying this, we are paying this executive many millions. We're not talking 1 million, we're talking many millions here. That is all. Sorry that I was very fast, but I want you to have any question if you want.
Right, thanks for that, Sheila. So has anyone got any questions on the report? No, remembering that this is just a report to note. So I'm going to go to Dr. Bloxham first.
Thank you, Chair. Yeah, the first point isn't really a question, but maybe just for me to note is that I'm completely opposed to virtually everything in this report, the entire approach. Don't want to rehash any arguments though, so we'll just leave it there. The second thing is a question. It's just when we filled in our survey, the staff filled in their survey about responsible investment. I mean, it's quite a low return rate anyway, so it's a small minority of staff did it. But of those that did it, there were big differences between what they found important and what they didn't find important within responsible investment. And I just wonder whether the approach you take takes those weightings into account, the things that people are not that bothered about and the things that they are really bothered about.
Okay, first of all, the approach we take is we try to look at the entire portfolio. So we try to weight what are the risks in the entire portfolio. So it's all the 14 partner funds. However, I did create the engagement theme called sensitive and topical topics, topical area, just to address if there are topics that maybe are outside the other bucket, we can address it because we need to have. Sometimes it's very easy to engage with the company. Sometimes it's a reputational matter not to engage. So we're trying to take everything account, all the member, we are very thankful when we receive the feedback from the members, and so we can integrate it. Usually we tend to have the same bucket, so we try to integrate this, but there are sometimes areas that they're not freaking many buckets. So this is why I create a little kind of a buffer zone. So we try to do both. We try to look what is important, what is not important, but there is the overall portfolio and the overweight, so the conviction that the manager actually had on those stock that actually also drive our idea. So we try to have a mix of everything.
Oh.
But the conversation with you is very important for us.
Okay, Dr. Bloxham, you're going to leave it there. Can we just have a little bit of an explanation about where we are with the RI kind of, because it's got a bit complicated because we're the pooling and with our own, what's happening with that? Because someone just kind of pick that up.
Yeah, so
please.
We were kind of waiting on this final guidance that we've now received. It's clear we need to work with the pool and partner funds to create some kind of consensus where possible, but then it kind of goes to Louis' point earlier about if some partner funds need a more targeted approach. The guidance is clear that responsible investment is in the remit of the committee, so it's not necessarily something that I guess the pool would have control over for the fund. But obviously, if we create consensus, then that's probably the best way forward. And we obviously had the scheme member survey back at the beginning of this year, which committee saw in March, and we fed that over to Sheila about the issues our members that responded feel are important. So we're continuing to have those conversations.
Yeah. Okay, that's great. Thank you. I'm going to go to Rupert, sorry, Mr. Sims, sorry, I couldn't quite remember your first name there, sorry.
Sorry, thanks. I've got a couple of questions. I can take them one at a time, or maybe give somebody else an opportunity.
No,
The first one was about your slide 5, and you gave a breakdown of voting, and I wonder if you could just briefly give an overview of the circumstances in which you might abstain, or what that other category means.
Okay, let's actually start from the easier one. Other is sometimes what we have a choice to decide whether we want the say on pay the say on pay to be actually disclosed on an annual basis or a triennial basis. So they're like a admin level. So the company would ask us, would you like to be able to vote on say on pay every year or every 3 years? That is the other. So this is a very and abstain for us. It's very important the abstain vote, because sometimes we, especially on the shareholder resolution, we might like the sentiment of the shareholder resolution, but we actually believe the shareholder resolution have already met by the company, or the company have given us commitment that they're actually going to address the ask of the shareholder resolution. Equally, the company has not yet made public the commitment they gave us to us. So we are in the fence. We use it as a fence vote, because sometimes we understand the shareholder resolution. Sometimes the company tell us that they're going to address it, and we don't have actually public evidence. We need public evidence that the company are actually going to move. They're going to actually provide that information. So this has actually become very difficult for us to judge. We don't want to vote against, because the company have responded to us. They give us the evidence, but it's not public. If it's not public, how can you actually see that? That is actually the way of abstaining.
Okay, thanks for that, Sheila. And did you have a second question?
If I may, yeah. It appears to me, and I may have misunderstood from Kat's presentation, that the UK government's taken a fairly strong line that whether or not its foreign policy is ethical, that our investment policy should not deviate from it. Now, I understand the difference between a responsible investment policy and an ethical investment policy, but the themes in your responsible investment policy clearly include human rights. So I wonder what the opportunity is for pursuing members' interests in human rights via engagement, even whilst you might be prevented by the UK government from acting ethically in your investment approach.
As far as, okay, first of all, our human rights approach is based on the United Nations Guiding Principle, which is actually one of the framework, which is actually based on the Bill of Human Rights, which actually the UK government is fully supportive of all the international convention, international norm of human rights. Let's say 95%. And so there are no contravention with the UK, because what we actually asking is the UNGPs, which is actually having a human rights policy, having due diligence. When there is conflict, heightened human rights due diligence is required. Still, when we actually engage, for instance, let's actually be clear, when we actually engage in a company that actually are operating in conflict, we are not asking to take side or not to operate there. We're just asking company to have strong due diligence to make sure they are aware of the risk involved in the actual area where they operate. For instance, Motorola, we address them, we actually engage with them because they operate in Israel, they operate in Syria. So this is a multiple thing. So we ask, how do you carry due diligence on the human right where your operations are, and how do you assess your risk of business continuity? And if we are talking with the oil and gas and mining, we will ask, do you have a UN guidance on security to make sure controversy like Lafarge never happen, where actually they hire terrorists to safeguard the mine, this is the area where we talk. And the UK government is actually fully supportive.
Okay,
This
all right. Okay,
I hope I answer.
I'm gonna go to Mr. Cartwright, Councillor Cartwright.
Thank you, Chair. I share some of Dr. Roxham's concerns, but not all. And I may have misunderstood what you said, but in part of the presentation, you mentioned about voting against. I mean, I fully welcome the opportunity to have a vote at particularly large companies meetings, which we've talked about in the past, and great advantages to that. But when you talk about specifically companies and having concerns over chief executives or directors pay against their outcomes and not being transparent, that would give me huge concern about the amount of influence between the fund and the particular company in relation to ultimately the fiduciary duty is the return. And I get that there is a conflict sometimes between, and it's been widely publicised just recently in the press about chief executives' pay particularly, and the pay ratio between that and the pay gap percentage between employees. But ultimately, it is the results of the company and not who gets paid what as to how profitable it is and the return for in our fiduciary duty. So I don't think you can probably answer that right now, but I might actually bring a question back to a future meeting about the influence between voting rights and pay, to understand that we're not crossing the line or making it difficult for those wonderful companies to produce the results. That does concern me.
Can I please answer? Because actually I can give you an example.
Yes, please, if you could, that'd be great. Thank you.
There is, I actually fully agree with you. That has to be very, it has to be very thought, because we want to, first of all, we want to promote growth and innovation in the company. And in general, we actually very supportive of the management. So let's actually make an example, Shell. Shell, they actually increase their quantum this year. However, the actual executive plan is perfect. It's actually good. So what we only have asked them, and we actually voted in favor of Shell remuneration policy. In the UK, you have two votes. You have the remuneration policy, which is actually the plan on how pay will be paid, will actually be delivered, what actually are the criteria. And second is actually the say on pay, how the policy is being actually delivered. Have you actually followed the policy? So this year was a year of the remuneration policy for Shell, and we actually supported, although it's quite an increase. But we believe, first of all, the position of Shell, the position of LNG, the disclosure, the level of scrutiny and the confidence we have on the remuneration committee, that is very important too. We need to have full confidence that the remuneration committee is has got the right talent, asset, understanding of the company. That we like to vote in favor. We were one of the few people actually voting in favor. So I think you are correct. You are very right to be concerned, and this is why we take it very seriously. That when we vote against it, is because either we cannot trace the link between our return and that pay. There is no disclosure. Lack of disclosure is a problem for us, or just an award out of the nothing. Sometimes we see upward discretion. That is not acceptable. Should not be. Why should we pay the price of non-financial performance? And maybe there is this is the area where we are very concerned, is upward discretion. I hope I answer your question.
Yeah, that presents a completely different picture and is welcome. Thank you.
Okay, thank you. Has anyone else? Paul?
Thank you, Chair. And I'd like to thank you for the presentation. I thought it made the approach really clear, and I thought it's very helpful. I just wanted to sort of talk about the RI survey. I know there was quite a lot of turnout for that survey, actually, and it was quite a great response rate this year. And I know it's been shared with you, but actually in terms of this sort of approach and the response to that survey and how you took that into account, I wonder if we can share that back to members who responded to the survey so that they feel looped into what's occurring.
Yeah, just to say there is an action on the RI plan that we communicate back to our scheme members and those that responded, because Central are still going through their a review of their stewardship approach, which we've fed into, so hopefully they'll take into account our responses, and then also on the climate strategy side, how we've taken their views into account as part of the development of that, and that will come to committee later in the year. And then we'll be able to communicate.
You feel that? Yeah, so there'll be a communication going out to scheme members, 110,000 of them, later in the year, explaining what the stewardship outcomes have been. Excellent. Okay. Dan, you've got a question?
Thanks. Just got a couple of points. I mean, what one with the response from the survey, which it seems to be up, but of course a lot of people don't sort of respond to these surveys, despite the fact they probably have views and agree with a lot of what's being done, or maybe disagree. But I think those that I do speak to who don't return the surveys generally support a responsible investment approach on what we do. The other, it's just a quick one on about the influence that we do have in all these different companies, or LGPS do. I think I'd say, is it relatively small, or is it so we're not actually dictating, we're just sort of there to be able to ask these questions, and we can be quite easily overruled on these things, but it's enough there to be able to ask the questions.
Yeah, our it's called issue share per capita is always talking about 0.0. It is very small, and also we tend not to co-file with other investor, because we rather actually have a one-to-one dialogue. So we also do not exercise the right to co-file or collaborate with other investor.
Thanks, that's great.
Okay, thanks for that, Sheila. Okay, so there's no more points, and we need to move on. So I'm going to recommendations. Committee is asked to note the responsible investment update report. Is that agreed? That's agreed. So thanks very much, Sheila and Mark and Louis. And so we're going to move on to the next item on the agenda, which is item 10, which is the cash management policy and forecast report, which is pages 93 to 100 of the agenda. This is actually a report that has come out of questions that were raised by members of the committee at our last meeting on the 20th of March. So this is Bunesh is introducing this report. So over to you. Thank you very much.
Thank you, Chair. So yeah, as pointed out, the purpose of this report is to provide the committee with details on how the fund manages cash balances following questions at the last committee meeting in March 26. It also includes background on our SAA, the CMS, which is the cash management strategy, why we invest in private markets, and the background to reducing our public market exposure. And finally, the cash forecast to the end of March 2027. The fund does update its SAA annually, usually at the January meeting, as you're probably aware. The proportion of the fund that's allocated to each of the 9 new asset classes that Louis mentioned a bit earlier are listed at point 2. The last meeting was advised by Hymans Robertson in Future. Investment advice comes from LGPS Central. The SAA is included within the ISS investment strategy statement. The ISS was presented for approval at the 20th of March meeting to the LPC, the committee. It includes the fund's cash management strategy and our weightings to each of the asset classes. Cash is allocated at 0%, just for completeness. At point 10, we've got our current target allocation. You'll have seen this in various reports, usually every quarter. The third column across is our current proposed strategic asset allocation, and right at the bottom there you've got cash at 0%. You've also got on the fourth column across our tolerance ranges, and we've grouped them into three distinct areas. So, you know, that top three, listed equity, other alternatives and private equity, we're allowed to go plus or minus 2.5%. That middle four, plus or minus 2%, and that last bottom bucket, which, you know, you could argue is the stabilizing piece or the protection piece, plus or minus 2%, around that middle band of 10.25%. The tolerance ranges and why we've set them and what they're used for are included at point 11A to D. I won't read them all out, but it gives the fund flexibility around how much you're allowed to go above a certain allocation or below a certain allocation. And there's a list of reasons there listed at points A to D. Just going back on why we've ended up with as much cash as we have over time. Point 16 starts to talk about at the 2023 meeting. So, you know, three whole cycles ago, the committee decided to reduce public markets by 7%. We took 4.5% off listed equities and a 2.5% off other alternatives. And we added that to private markets. About 4.5% went to private markets. Alongside a 2.5% to liquid credit at the time. So that shift to increasing private markets allocations also coincided with LGPS actuarial valuations, which showed many LGPS funds across, not just ours, but across England and Wales, were now over 100% funded. So this shifting away from the riskier parts that Louis mentioned earlier, listed equity in the main, where the highest risk coincides, we pulled back a little bit, and in doing so it naturally ended up in cash in the first instance, whilst it was being reinvested into private markets, which, you know, we've all heard takes a number of years. 20 to 23 talks to our current cash position. You're probably aware, if you've read some of the other papers or the appendices, as at the 31st of March, the value was 505 million, so that's 7.4% of the fund. So it's still a hefty amount as at the 31st of March. Point 22 talks to the latest position as at the writing of this paper. So we're about 320 million. So we've spent a fair amount of that. So that's come down to about 4.3% of total fund assets. About 195 million was invested between the 31st of March and when we wrote this paper. Some of it went to the UK gilts product that Louis talked about, and some went to the multi-asset credit fund. They're the two main areas where money was spent. 24 to 27 talks to the forecast to the 31st of March 27, which was part of the point from the last committee. Where do you think we'll end up within a year or so? And we've got a table at point 26 in the paper, which shows that with the expected calls from the private market commitments the fund has made, we should be around 230 million, which is around 3% of the fund. So within a year, we should have knocked off a fair portion of that cash holding and be down to about 3% of total fund assets. 29, I'll just read that section out. So at the time of writing, the fund had 900 million pounds worth of outstanding commitments. We only have 300 million pounds worth of cash-ish. That mismatch is by design. We aim to reach the desired increased private market allocations from a number of methods. So we'd fund from existing cash. We've got 300 so million. We'd then fund returning capital from older private markets, because they're always returning cash. And then finally, we could sell off some of the overweight positions, such as in listed equity. Don't think there's any other bits I want to talk to unless there's any questions.
No, okay, thanks for that, Bruce. Has anyone got any questions? I think the table's extremely illuminating between paragraph 26, 27. Nick?
Thank you. Is the fund still cash flow positive in terms of the pensions paid compared to contributions?
Yes, broadly, it'll be less cash flow positive than it used to be, and will be, you know, given the size of the employer reductions, it will have got a lot smaller. It's not, it wasn't a huge amount to begin with, but it'll be smaller. But yeah, neutral to positive.
Okay, anyone else got any points? I mean, I think to me this looks, broadly positive that we're reducing our cash exposure down. I mean, it's a big number, but as a percentage, by a year's time, we're going to be at 3% of assets under management. This is the problem with when you're dealing with large funds. Any percentage is a big number. I mean, I think we all understand that. So the question I've got for you, Bulish, is, and maybe Louis, is what is our, I mean, I know have we set a target for what the cash percentage of assets under management we should be holding? If so, is it 3% or is it lower than 3%?
It's 0.
Zero. Well, is that realistic to have a 0 target? I'm just throwing that out.
So, true 0, no, it's not realistic. You're always going to, well, there's going to be, going forward, cash will be split into operational cash, so the cash coming in from contributions and paying out. So you're going to have a float there. And then there's investment cash. And again, some degree of float is going to be needed because these private market commitments will require, 6-7 days notice, and we need to source cash. So to your point, that amount of cash could be in the rounding. So it could be, it's not going to be true 0, but it might be, 0.5% or below of total fund assets in the long run.
Yeah. So I'm just wondering whether 0, having a target of 0, it might be, is that actually the appropriate target to have?
We'll certainly consider that as part of the January review of the allocation. But you're right, given we've got £900 million worth of commitments, sometimes they're very lumpy. As Louis mentioned, you get 5 or 6 working days notice to provide a manager £10 million. And if you're not holding enough, you can get 3 or 4 of those appear at the same time. And then you have to sell assets quickly, and that might not be ideal as well.
Yeah. Okay. Martin?
I agree with you, Chair, but setting a 0 it is fundamentally practical, doable and respected. But you could have a note around it. True 0 isn't possible for the reasons mentioned, which would actually make it clear. So to have an aspiration of 0, I think is plausible, but to get to 0 isn't. So that explanation around what you've just alluded to, being a footnote to it, would be helpful so that people can't challenge the fact, well, why are you holding cash at even 0.01% when you could make better use of it, has been said in the past. But actually getting to 0 is not practical. So if you had a footnote around it, around what you said, Chair, then that would be all things to all men and women.
I think that's a sensible thing to do. We're looking at we're doing a kind of annual strategy update, and I think that's one thing that we could put into that.
So that'll be something you'll bring to us late in the cycle
in January.
In January next year, so we can look at it then, and that's something. But in terms of this report, has anyone got any other queries or questions about it? I think it's very helpful. Okay, so we're being asked to just note this report. So is that agreed? That's agreed. Thanks very much. So we're going to move on then to the next item, which is item 11, which is valuation of pension fund investments. This is on page 101 to 116 of the agenda. And this is Bulish again. That's over to you. Thanks very much.
Thank you, Chair. So yes, this is the fund's usual quarterly update. Purpose is to provide the committee with an update on investment markets, how individual asset classes are performing, and the total value of the fund's investments at the quarter end date of 31st of March 26. We've got a fairly big section at the beginning, points 2 to 16, cover performance, outlook. I'll cover some of the main points. Louis already covered many of these already, so we'll rattle through fairly quickly. So global investment markets delivered a positive return over the year ended 31st of March. Performance was uneven across asset classes. We saw that on that table that Louis pointed out, and it's also in this paper here. So global equities were strong, supported generally by financial conditions. By the 31st of March 26, the MSCI World Index delivered nearly 20%. Fixed income also produced positive returns over the year. An index, the Bloomberg Global Aggregate Index, which measures the performance of global investment grade fixed rate debt, returned 4.3%. So as Lou mentioned earlier, a lot lower. We'd expect that it's lower risk. Commodity markets were substantially stronger over the same period. An index, the iShares S&P Commodity Index Trust benchmark returned 43% in 1 year. And that benchmark is heavily weighted towards energy, also includes agriculture, industrial and precious metals, and livestock. So overall, that year to the 31st March 26 can be characterized as one in which risk assets again performed well, especially equities and commodities. Bonds generally positive but modest. Markets remained concentrated. We've heard earlier, technology and AI related themes continued to play an outsized role in equity market performance. And as a result, we've got concentration risk and it's increased materially within our passive global indexes, becoming dependent on a smaller number of companies. And if you reflect on how the fund is set up, our listed equity exposure is heavily weighted towards passives. We do have a smaller component, which is actively managed, which is the one product that Mark was talking about earlier, the Global Active Multi-Manager product, which can benefit from not following the index and then weighting towards areas that could be perceived better value. Point 14 just illustrates how strong listed equity markets have been over the past 1, 3, and 5 years. I won't stop there. We've talked about that one. Point 16 is our usual table of major central bank interest rates and directions of the last moves alongside inflation rates, which investment markets kind of digest alongside any forward guidance issued by central banks. 17, A to D gives a summary of Hyman's Capital Markets Review. It comments across 4 asset classes. A summary is provided in each of these areas. So it's got Part A for equities, Part B for UK government bonds, Part C corporate credit, and Part D UK property. That's at point 17. The table at 18, which we've seen previously on the central slide, is one that we've been using for many years now. A summary of global asset class performance over various timeframes as at the quarter end 31st of March. Standout classes over the longer term remain listed equity, essentially US equity, private equity, and gold. Double-digit performances over the really long term. US equities and gold both over 10% over 10 years and 20 years compounded. Section at the bottom of 95 is points 19 to 22 is portfolio changes during the quarter ended March 26. We didn't do any rebalancing. However, we did commit to 2 central private equity vehicles totaling 80 million. They were approved at the meeting of the investment subcommittee in October 25. We also had the first capital call for Central's private credit real assets vintage. The fund has committed 130 million to that product, so it's good to see that product finally making calls for capital. 23 talks about the approvals at the last investment subcommittee, so we've not had another one since the 1st of October 25, and 23 A, B, and C talk to the commitments made at that meeting. 24 and 25 cover the SAA changes from the previous year. So this is a summary. Essentially, the one change that we have briefly talked about earlier is the change to adding a new component, fixed interest UK government bonds, which we didn't have previously, target of 2%, about 150 million. That was satisfied by investments made to that legal and general product that Louis talked about in June in the main. So a 40 million investment, a 40 million investment, and a 50. And a summary of the process that Louis has talked to is included points 26 to 30. Just going to move forward to the table at 41. Shows where we are as at the 31st of March against the 2026 target allocations. no surprise here. It's a similar story that we've heard over a number of years now. Overweight in cash, underweight in income. It's slowly being reversed. As we mentioned, we've made a lot of commitments over this time between the 31st of March and now. So, and we expect that cash component, which is showing on here, to be reduced to about 3% when we get to March 2027. Moving on to overall investment performance for the fund, starts at point 42. We've got a table at 44, which shows returns for the fund over 1 year, 3 year and 5 year. Over the short and medium term, 3 and 5 year time periods, returns for the fund are comfortably positive, 7.9% over 3 years and 7% per annum over 5 years. They compare favourably to the most recent Hyman's actuarial valuation, which calculated the future investment return required by the fund to be about 6.1%. The fund does target, however, an investment return ahead of that. It gives us a bit of leeway in case we have some bad years, and the fund is targeting around 8.4% based on its mix of investments and target allocation. So if you think about, we have circa 40% in listed equity and we have circa 10% in kind of safer assets. When you average it all out, the last Hyman's calculation suggested that'd be around 8% over the long term. So we've got a little bit of margin over what we need to return and what the strategy is expecting to do over the long term. We've also got a little table at 48 to show how our fund compares with other publicly available information from 3 other LGPS funds, which happen to be in our central pool as well. Their 1 year return was between 10 and 10.1, very tight to be fair, and their benchmark was 11.7 to 12.9, so slightly below where they expected. Similarly with us, 10.5 over the 1 year, a target of 12.6. I don't have any other points to read through here unless there are any questions.
Okay, thanks for that, Belush. Has anyone got any questions? You want to queries or anything? Nick?
Very quick. In terms of the UK bonds, we talk about the UK gilts. So what duration are they?
They're the whole benchmark, so it covers all durations, but I can't remember what the average was.
Okay, come back. Yeah, that's fine. That's fine.
Can you provide an answer after the meeting? That'd be great. Thank you. That can be circulated round. That'll be great. Thank you. Recommendations committees have been asked to note the valuation of pension fund investments report. Is that agreed? That's agreed. That's great. Thank you. If members would like, we could have a 5-minute break, or do you want to just press on? Press on. Press on. Okay, great. Okay, that's fine. So we're going to move on to item 12, which is Fit for the Future update report. I'll just get the right page numbering because it's not right on the little crib sheet I've got. It's page 105 of the agenda pack. Thanks very much. So over to you, Kat, and there is also a recommendation. So as well as being noting the report, there is an additional recommendation I don't think is actually in the report, as I understand. And I'm just going to need to read that out, so I can do that now. So we're also being asked to approve that the Director of Corporate Resources, in consultation with Chairman of the LPC, Local Pension Committee, be authorised to make a final appointment decision, having taken into account any views expressed by committee members. I'm sure, Kat, you're going to explain what that is all about in over the next few minutes. Thank you. Over to you.
Thanks, Chair. And yes, I'll get to the recommendation we're asking for. So this is the report on the Fit for the Future reforms and the progress that's been made since the last update committee had in March. And we also have a bit of an update on governance matters related to LGPS Central on the shareholder side of things, so separate from how we've had a bit of client matters earlier today. So since we last met, the Pension Schemes Act 2026 received royal assent, and this came through on the 29th of April. Following this, government published its response to the Fit for the Future consultation on the 21st of May, and this confirmed that the new LGPS pooling and governance regulations would come into force on the 30th of June. Government published the final guidance for that the day before the regulations came into force. So we're kind of gonna have to be working through them to make sure we're compliant. And we had seen the draft guidance before, so we're working through where that's changed from what we expected, and I'll kind of come on to some of that briefly. So this report focuses on the fund actions. We also have details that we need to work through with our other partner funds and LGPS Central to make sure we're compliant on that side, but this is just focused on the actions we need to take as a fund. So one of the changes that's came out is that the fund has until the 31st of March 2027 for its revised investment strategy statement. This is in line with our normal review process, so we expect this will be fine, and we also think we've already done a pretty good job in bringing our compliance in line with the like government's 9 investment buckets, for example. Two key areas are the 2 new roles that are highlighted in the report. So we'll have until the end of December to appoint a senior LGPS officer and then an independent person. So if I go through just briefly what they intend by the senior LGPS officer, they want this role to be a dedicated senior officer with responsibility across all pension fund activities, across administration, governance and investment matters. They are quite clear that the role cannot be combined with the Section 151 officer or other statutory positions, and it's expected to be focused primarily on those pension fund responsibilities with clear independence from other local authority responsibilities. The second new role is the independent person, and they will be required to act in an advisory capacity for the committee. The purpose, government see this as a way of strengthening oversight and decision making as governance arrangements become more complex and investment implementation continues to move through asset pools. There has been some slight changes to the role in the final guidance and who would be eligible to do this role for the fund. But it's also been made clear that we can either appoint to the role or procure a firm in line with how professional trustee firms work, as long as we have a named person who would be the fund's advisor. So the guidance is clear that this role should provide objective challenge and advice across investments, governance and administration, and we'll have to work closely with the chair of the local pension committee and senior LGPS officer. As we've now essentially finalised the role overview, we are proposing a resolution within this report, we're tabling this to ensure officers have appropriate delegations to progress with this appointment. It also says in the report if members are interested in taking part, for example, meeting with a prospective candidate, to let us know, and then we can involve that within the process and then make sure any feedback is collated and considered between the chairman and the director of corporate resources. Another key area that we'll need to work through is the requirement to undertake an independent governance review. So we'll need to undertake this ahead of March 2028. So we have some time to make sure we are compliant with all the areas within the guidance, and then procure someone to review the fund. We'll then have to report on that to government and set out any clear actions and how we're going to get up to standard if there are areas which we don't meet. And then at the end of the report, we have a brief update on LGPS Central. So there was an LGPS Central company meeting held on the 23rd of March, which was just after our March committee meeting, and they approved, and the shareholders approved all resolutions as set out in the report. There's also a piece about the shareholder representative going forward, but that's also in a later report, so I'll leave it there for any questions, Chair.
Okay, thanks for that, Kat. So I'm going to come to you in a moment, Martin. So let's just be clear then. There's two kind of roles. There's the senior LGPS officer. So what's the plan? We're going out to recruit someone for that? And do we have a timetable for that? And if so, what you just mentioned, Kat, about members of the committee, I assume this applies to the board as well, does it? Or is it just the committee that this is involved with?
So the talking about the independent person is where I'm talking about involving the committee.
Oh, right.
There did used to be a requirement that the independent person should have a close connection with the chairman of the local pension board, but that's dropped off now. So it seems a very committee focused role.
Okay, so what you were referencing there was just about the independent person or firm, not the senior LGPS officer.
Yes.
Okay, so let's just deal with that first. Personally, my personal view, and I suspect the committee might want to do this, they might want to meet with whoever and have some sort of ability to kind of meet potential appointees to that role. Do committee members want to do that? If that's good, Martin?
It was going to be my question, Chair, so I'll help you a bit with that. So what I was going to suggest was that if you just put out a communication, Angie, to all members, saying would they like to be involved in that process, and they can simply ask yes or answer yes or no, and then it delivers what you're trying to achieve there.
Well, I'm asking now. We're all here now. So do you?
Well, people not want to think about it.
Well,
so I was thinking.
Okay. Well, the officers can come up with a scheme of which that can be done, and if it meets with your diary or whatever, you can then take part or not. But if we give a clear steer now to the officers, they'll come up with a proposal.
I'd happy to be. So I'll kick that off.
So I think we would like you officers to come up with a way of us doing that, respecting all the necessary processes that we have to do. Yeah. And so if we could just then move on to the LGPS senior officer then, how is that going to be? What's the process for that and how's that been taken forward? Thank you. Simone.
I take that one.
Yeah.
So we are just, the guidance came out early this week. So we are just reviewing that and discussing how the responsibilities of the officer will be best carried out, drafting a job description and then looking at how it's going to best fit in the structure that we've already got. It does have to be in place by December. So I think we will need to make some decisions over the next few weeks about how that is best.
So in terms of recruitment process then, you're looking to go out, are we going to go out to the market and try and find someone?
That's what we're still considering. We need to look at the guidance, look at the existing structure and job descriptions and where any overlaps might be, what we might be missing in terms of the current structure, and then decide what we need to bring.
So between now and the next committee meeting, which is in, I think it's September, you'll be able to, once you've finalised what you're doing, will you be able to update committee members?
Yeah, I think in September we'll look to bring an update on both of those in terms of any remaining timescales.
Okay, excellent. Okay, Martin.
So still on the independent person, just trying to understand how this fits in. So the independent person role is effectively, as we'd know as councillors, a scrutiny role that can give an opinion on the committee's agenda. But the two questions I've got around that is, I'm sure I've got this right, but I could be wrong. They don't have any voting rights. They express an opinion on the agenda items, which we may or may not follow. Is that how it's going to sit or not?
Yeah. Kat, do you want to answer in that?
Correct, that they won't have voting rights, so they'll sit outside of the membership. In terms of, I guess, the advice, they won't be able to give, I suppose, advice out of the blue that would conflict with LGPS Central. So we wouldn't expect them Central to have, say, this is what we're planning to invest in, and then the advisor to say, you should actually invest in this other manager. That's not their remit. It is kind of challenging, I guess, the advice from LGPS Central, and just helping the committee scrutinise in a stronger way. And there is quite a lot in the guidance about the role works quite closely with the senior LGPS officer. So I think ahead of committee meetings, any of those kind of big disagreements or conflicts would probably get worked out in that way. But it's a new role, so we'll have to just see how it works in practice.
Yeah, I think just in also come back in there as well. I think originally it was intended there'd be a member, an actual member of the committee. Now it's been decided they're just an advisor. So it's kind of, I haven't had time to read the guidance myself, but I understand from what you've said is that they're there to kind of provide advice on governance matters or all matters.
So administration, investment.
Are they a financially qualified person under the FCA?
So they don't need to be FCA regulated, but there are two requirements. I think there's a Pension Management Institute's qualification, and they can either have that or another, but it's not quite to the level of FCA regulation that we've had to have in the past.
Yeah. So it is a bit like a scrutiny, but like, as it says, independent of anyone in this room, basically. And so they can come along and say, I don't agree, or think you're going the wrong way, or whatever it is, they're going to come up with. I think that's, as we understand. Martin.
Very, very clear that it can't be a Section 151 office, and all the other disqualifications, but slightly more controversial. If it's not a voluntary role, if it's a paid role, who bears the cost, and how is it distributed amongst the cost?
So the independent person, that will be remunerated, and that's clear in the guidance. And we're just considering other roles out there, and so we can pay an appropriate to get someone appointed, but we'll have to see how that goes. But that will be from the pension fund. So
the pension members are going to be paying for it, the 110,000. So it'll be a running cost of the administrative cost of managing the fund, basically. That's right. Is that right?
Progress then, Chair.
Yeah, Simone?
Just so Hyman's did produce some briefing notes on all of the guidance yesterday, which are quite helpful and summarise the guidance. So I think we'll get those.
Will you be able to circulate those around? That will be brilliant. Thank you very much. We'll enjoy reading those over. Perhaps you can read that if you're not watching the football match, or moping after. Sorry, we'll see. Right. So, anyone else got any other points, or can we move on? So, we've got the recommendation is that A, we note the Fit for the Future update report, and B, subject to us having a kind of gathering and meet and greet, whatever it's going to be called, approve the Director of Corporate Resources in consultation with Chairman of the LPC, be authorised to make the final appointment decision, having taken into account any views expressed by committee members. I'm happy to move the recommendation above. Have a seconder?
Second.
Mr. Grimley, is that agreed? That's agreed. Thank you. Unanimous. Thank you very much. So we're going to move on then to risk management and internal controls. And this is on page 111 to 121 of the report. I'm going to suggest, because we've got quite a meaty item which we still need to take, that we take this report as read if everyone's in agreement. Everyone agreed? So we're going to take that report as read. Thank you very much. And so
then... Sorry, Chair, I think you still need to approve.
Oh, we still need to do the recommendation. So the recommendation is committees asked to note the risk, A, note the risk management internal controls report, and B, approve the updated pension fund risk register. And I'm happy to move the recommendation. Can I have a seconder? Dr. Bloxham. Is that agreed? That's agreed. Thank you very much. So we're going to move on to the final substantive item for this part of the report, which is the terms of reference update, which is at pages 121 136, and this is over to you, Simone. Thanks very much.
Thank you. So this report asks committee to approve the revised terms of reference. They were last revised and approved in June 2025, but since then, given all of the activity on Fit for the Future and the guidance and regulations that we've been talking about, we have undertaken a further review to make sure the terms of reference are aligned to what they need to be in terms of the new regulations and guidance. So that's both the LGPS guidance, the Council's constitution, because there were some minor changes that we needed to reflect there, and the Fit for the Future programme as well. Paragraph 6, the report's bullet points the main changes that we've made, and then the appendix shows those changes highlighted, just so it's easy for you to track the changes. Some of those main updates include just some clarification around the committee's roles and responsibilities, again, particularly in light of Fit for the Future and the new regulations. Some clarification around substitutes and how the chair and vice chair are appointed, and also membership of the investment subcommittee, just to clarify that and how members are appointed to that as well. But I guess the key change, and the one to bring to the committee's attention, is in relation to the fund's shareholder role in LGPS Central. And following some legal advice and the development of the shareholders agreement, the report proposes that shareholder representative needs to be an officer. Again, that is based on the legal advice. So the report recommends that the role is delegated to the Director of Corporate Resources as the Section 151 officer, with the Assistant Director of Finance as the Deputy Shareholder Rep, just as and when required. We're also suggesting that the shareholder representative be authorised, be delegated to authorise another officer to act if necessary. So if the 151 is the representative and the deputy are unavailable, if that was to happen, to allow another representative to be authorised, another officer. And that's just to make sure we've got continuity if the case was ever to arise. And that, again, that is the main change, really, and something that the committee will need to be comfortable with. We will continue to update the committee on updates on shareholder and company matters as we need to. And I think we're kind of still working through those reporting mechanisms with LGPS Central, and how frequently the committee will get those updates. But it's really to ensure that the terms of reference do remain relevant and fit for purpose, and are keeping kind of pace with those regulatory developments as well. So committees asked to approve the revised terms of reference, which are set out as in the appendix, and approve the shareholder representative arrangements that I've just mentioned, which are also in the recommendations. Chair.
Thanks for that, Simone. So I just want to add a bit more kind of context to this. So basically, over the last year or so, since I became chair of the committee, I've attended meetings of the shareholders, and what became clear to me and other colleagues who were new into the role from other participating committees is that the shareholder committee was basically we're supposed to have this committee which was supposed to meet of elected members to discuss kind of like a supervisory committee, and then there was the shareholder representative, and basically the two things, one was not meeting at all, and so everything was just going to the shareholder committee, which was really just to run the company. But instead of that, it was getting into all the detail that we didn't really need to have at the shareholder committee meetings, as I understand. And so it ended up being this kind of complete, well, it was a bit of a mess, really, quite frankly. So, so it's taken quite a long time, and then we've had Fit for the Future come along as well, which has required us to strengthen governance and improve this. And then it's turned out that actually an elected member can't be the shareholder representative, which is great because that saves me a lot of meetings. But that means that one of the officers has got to be nominated, which is why this has come about, really. And we've got to cover that off. But at the same time, what we're trying to do is actually get this oversight scrutiny meeting, because obviously it's now not just 8 of us, there's 14. The Isle of Wight are clients, are they? No, they're not. Okay. So there's 14, you know, and we've now got to work out how this is going to, you know, basically work, which there's a lot of work being going on behind the scenes, a lot of meetings and discussions about this. So I just want to reassure colleagues, this isn't just something that's come out of the blue. This has been being worked on for quite some time to try and get this functioning in a way that it ought to really be working, and this sort of, in a way, the Fit for the Future gives us an opportunity to reset and actually get things set up in a better way and properly functioning. So that's basically the context, and you know, so it's important we get this right, because you know the duties and responsibilities of shareholder representatives are different to those of the pension committee, because we've got different issues we need to discuss instead of it all being in the one meeting, which made it a very difficult meeting for everyone to participate because everyone had a slightly different angle. And then for the directors, I think they found that difficult as well at times because they just wanted to talk about managing the company rather than all the detail that some of the representatives wanted to bring up. So that's it in a way. Has anyone else got any other points, Martin?
Just congratulations with having to open this practically on a daily basis as different things come out from different parts of government to make changes that then you've got to reflect on the changes to make changes on top of the changes. No, 10 out of 10 for me. I mean, if you want to move it, Chair, I'll be happy to second it. But congratulations for the expedience and the quality of work to bring this back. Bearing in mind, we're not using the philosophy of government. We'll tell you today, and it's got to be implemented tomorrow. But you achieved the same. So yeah, 10 out of 10 for me.
Yeah, I mean, that's been half the other part of the other issue has been there was a lot of debates on all the amendments in the House of Lords, and they all then had to go back through the Commons to be sorted out. And I mean, it's taken an eternity for everything to be signed off. So with that in mind, unless anyone's got any other point, the recommendation is that committee approves the revised terms of reference, which are set out in the appendix. B, that Declan Keegan, just quick query before I say that, if Declan, for some strange reason, you were to leave the employ of the County Council, we don't have to revise this terms of reference to then name someone else, do we?
It's probably a fair point that we should just do the roles rather than names and roles.
Do you want amended?
We should just do the roles.
Is that I'm just conscious if you or Simone left.
Yeah, no, it's a sensible.
Given we have LGR.
Thanks for your faith. I'm going to.
No, I don't mean it like that. I just mean, we don't want to keep having to bring it back because then it would, be another kind of paperwork exercise, wouldn't it? So, okay, so I'll just change that. So, item B, that Director of Corporate Resources and Deputy Chief Executive and S151 officer be appointed as the fund's shareholder representative for LGPS Central Limited. B, that the Assistant Director of Finance, Strategic Property and Commissioning be appointed as the fund's deputy shareholder representative for LGPS Central Limited to act where the shareholder representative is unavailable. D, that the shareholder representative may authorise other officers to substitute for them and perform their designated duties as set out in this paragraph on their behalf in their absence and in the absence of the appointed deputy shareholder representative. Well, that's covering all the bases, isn't it? And E, that the shareholder representative bracket and deputy or substitute when acting is authorised to exercise the administrating authority shareholder / company decision making in relation to LGPS Central Limited, including where required voting at general meetings, signing shareholder resolutions and completing proxy forms within the scope of the council's constitution and any relevant scheme of delegation. And F, that the shareholder representative will report back to the local pension committee as appropriate on shareholder / company matters, including decisions taken. And I'm happy to move the recommendations as I've amended. And seconder Martin, is that agreed? Okay, that's agreed. So that's unanimous. Thanks very much. Great. So then we're going to, item 15 is date of next meeting. Please note the date of the next meeting is the 1st of September at 10 o'clock. As I said, there's no other items that are 1st of September, 11th, is it?
Yes, typo, sorry.
Typo, right. I was going to say 11th, okay. We then come to, so then, as I say, item 16, there's no items that are urgent. 17, we now come to exclusion of press and public. So I move that public be excluded during consideration of remaining items in accordance with section 100A4 Local Government Act 1972 exempt information. Is that agreed? Agreed. That brings us to the end of the public part of the meeting. Live stream of the meeting will now end. Angie, to confirm when that's happened.